So you've built a trading model that you are satisfied with. You've run the backtests. The backtests look fantastic. You've built an algorithmic way to deploy it in the live markets. After all said and done, one thing is for certain and one thing only, and that is your model is incorrect. Now, just because your model is incorrect does not preclude you from making money. It's a very important distinction, and hopefully, as you've seen in my more recent videos, this is going to be the case, that all models are wrong, some are in fact useful, and you can in fact generate P&L with a model that is fundamentally incorrect. There's a lot of facets of game theory involved, there's a lot of facets of statistics and stochastic processes, but we're not going to dive into the technical details here. In general, what I want to do in this video is I want to talk about trading with violated model assumptions, because in any case, when you develop some sort of model, whether it's for pricing, trading, what have you, your assumptions are most likely going to be violated in practice. Now, why is this actually useful information? Because violations of particular assumptions give you information as to whether or not your estimated quantity is overestimated or underestimated. So what we're going to do is we're going to walk through different ideas in the modeling space. We're going to talk about parametric models and this idea of kurtosis. We're going to talk about independence. We're going to talk about stationarity. And we're going to look at some implications in trading in both the investing sense and the algorithmic trading sense. We'll start with this idea of excess kurtosis. Before we get into excess kurtosis, what the heck is kurtosis? Well, typically, if we look at a bell curve, if we look at a Gaussian and normal distribution, all of those are equivalent, and we look at the tails, a measure of peakedness of that distribution is something called kurtosis, the fourth statistical moment. Now, the kurtosis of a normal distribution is 3. That is, anything in excess of 3 is called excess kurtosis. So typically, when we visualize a return distribution, we see that the tails are larger than the normal distribution parameterized by that return series mean and standard deviation. What do I mean by this? Well, if I take a look at the kurtosis of this return series, you can see that the kurtosis of Amazon from 2021 to 2022 daily returns is 6.35. That means its excess kurtosis is 3.35. So in excess of the normal distribution, how much kurtosis is there? In other words, how fat are those tails? What are the implications of this in trading? If I'm investing and I have a stock portfolio, typically I'm concerned about how much money I could lose given any specific time period and the likelihood of losing that money. Common measure for this is value at risk. What I can do is I can take the mean and standard deviation of my portfolio or of a stock, and I can compute this measure of risk. I can say, hey, given some confidence threshold, 99% confidence, 95% confidence, whatever it is, how much money am I likely to lose? Or at max, it essentially puts a bound on the problem within a given time period. So in other words, let's say that I have a portfolio. Let's say the portfolio consists of a variety of different stocks, and I take the average return over the past year, and I also compute the standard deviation. Then I'm going to be able to put a bound on the likelihood of a loss exceeding that specific value. So I'm 99% confident that my portfolio won't lose more than 20% within a given year, for example. The problem with this is that we are using a normal distribution, a Gaussian. We are imposing that on the structure of the return space, when in reality this is not the case. Now, kurtosis is not the only assumption being violated there. Independence is also being violated, and also stationarity. But we're going to get to those. We're going to talk about this mainly in the context of kurtosis. So what I've done here is I've plotted the return distribution for General Motors relative to a normal distribution parameterized by that in-sample mean and standard deviation. And what you can see here is that it is not exactly normal. This is not fitting this line at all. Moreover, if you look at the empirical versus normal value at risk, you can see that it over and underestimates it at different confidence thresholds. So it is not even a great measure for the actual value at risk of your portfolio in sample. If you were using this in the live markets on your live portfolio, you wouldn't even have this in sample data. It would be even more insulting, this assumption being violated. And that's precisely what I have here. I have the previous year's worth of data being used to compute the value at risk for the following year. And you can see the parametric means of computing the value at risk severely underestimates the true value at risk for that following year. So in other words, if I use data from 2021 to try to inform 2022, look at this error gap for each confidence threshold. This is the idea of excess kurtosis. This is the idea that we are underestimating tail risk. Now, we're underestimating tail risk, sure, on both sides in some cases. That is, if we were to actually look at the probability of those extreme values occurring relative to a normal distribution, the probability of values in that region occurring will be arbitrarily higher, but on both sides of that distribution. So it's important to understand that in the context of this assumption being violated, it's not just in one direction. You may see, in some cases, the parametric value at risk is going to extremely overestimate the value at risk. And that comes from the heavy tails on both sides. So it's important to understand this violation, because when you see extreme values in either case, it's going to mess up your value at risk. You might be drastically underestimating your value at risk or drastically overestimating your value at risk. So in the context of investing, that's why this measure is important. What is a more appropriate measure of your value at risk? There's a lot of work being done in this space. There's a lot of work in a generative context, attempting to generate returns that are similar to different environments or regimes you've seen in the past. And there's work being done in the generative machine learning sense for this level too. But nevertheless, it's important to keep in mind that all of these models will inform different values based on the assumptions that are being made. Very important to know it's both over and underestimation, depending on how much time in the return series for the parametric model is being spent on either side of that distribution. Many times in statistics, we talk about independent and identically distributed draws. There's a lot wrong with assuming IID sampling, especially in a portfolio. Let's talk about why. Well, first is we know that in the context of excess kurtosis, when things get bad, things get really bad. So the likelihood of extreme draws is higher relative to something like a normal distribution. Sure, that can be the case. But we often talk about this idea of trend, and I use air quotes because I use that idea loosely, but when things get bad, things tend to ride bad like a roller coaster downhill. So what I mean is we see tariffs come out for the first time in quite some time, and everything takes a hit, right? The general market takes a hit, everything idiosyncratically kind of dissipates, and the market drives everything downhill. That is a violation of independence, right? Everything is moving together in one direction. So anytime you're assuming that these returns are IID or even independent from one another, whether it's on a stock-by-stock basis or a series of returns for the same stock being independent, we know this clearly is just not the case. And depending on the regime and the macro regime and the administration and decisions being made and all of these different things, this will be more or less true at different points in time. So everything in this video is not in an absolutist sense, because based on the current market conditions, the interpretation of this independent structure is going to change. Maybe things are more independent at some times and less independent at others. That is definitely true. But what is this idea of a correlation structure? Well, we've talked in the past about principal components pertaining to different facets of risk for a stock. And what I want to do here is I want to show you how this correlation structure exists and can hurt your interpretation of risk. It can hurt your interpretation of diversification, but it can also be used to your advantage to develop portfolios that are, say, neutral to different facets of risk. So for starters, what I have here is I have Microsoft, Amazon, Apple, and General Motors. I'm going to scroll on down here and I'm going to conduct a principal component analysis. You can see that within the first two principal components, I've explained 80% of the variation among the return space. First three over 90%. So that's a significant amount of variation. In the past, we've analyzed this idea of a market component, an industry component, and an idiosyncratic component. What I mean is roughly 60% of the variation in that return space is explained by some sort of market component. And this can be seen by looking at all of the loadings on each of the individual stocks. And if you take a look at the correlation with the first principal component and the S&P 500 returns, there's a strong correlation between the two. That is, as the first principal component increases, the returns tend to increase for the S&P 500. If you look at the second component, the industry component should likely be less correlated with the S&P 500. This is also the case, and the idiosyncratic component should probably be even less correlated with the S&P 500, and this is also the case. So in this context of lack of independence, right, what we really want to do is we want to find a way to isolate then the independent components. So in a trading context, right, if we are trying to develop some sort of trading strategy, maybe it's some sort of pairs trading strategy, then this correlation structure, we want it to exist, this covariance structure, we want it to exist. But in the context of diversification, we really don't, right? We really don't want correlation among the stocks to exist. We want it to essentially be neutral, right? That's the whole point, is that the idiosyncratic components kind of cancel each other out. But given that this correlation structure exists, is there a way to extract perhaps the orthogonal elements such that we can create a neutral portfolio? Here is one way to do that. So if we take a look at these principal components, right, we know that if we develop a portfolio of all of these stocks and we're trying to diversify, clearly we have this problem that the market component is not going to be diversified away. That is, we can diversify away this idiosyncratic and industry component, but we can't diversify away this market component. But is there a way that we can develop a weight in these stocks such that we diversify away that market component? In other words, can we have exposure just to this idiosyncratic component? Essentially, that's what we're going to do with PC3. So what we're going to do is we are going to develop a portfolio based on the weight, that is the linear combination of the stocks proposed by principal component 3, that is the idiosyncratic exposure, to develop our portfolio. And what you'll see here is the rolling correlation between the S&P 500 return and the principal component 3 is roughly mean zero, maybe a little negative. But look at the equity curves. You have the equity curve of the S&P 500 during this interval and the equity curve of our PC3 portfolio. We're rich. We're genius. This is perfect. Just go net long PC3, whatever the factors are, whatever the loadings are for each of the stocks, and we are set. We're market neutral. We're orthogonal to the market return, and this is great. Okay. That's definitely not what's happening here, right? What's happening here is we have idiosyncratic exposure, and idiosyncratic exposure outperformed the S&P in this particular selection of stocks during this point in time. That's precisely what we're looking at here. Moreover, this principal component analysis is done in sample. That's not to say that you couldn't extend this and conduct further research and develop some sort of portfolio that is in fact productive out of sample on a rolling basis. But that's a video for another day. What I've done here is I've just shown you that this independence assumption, though it's violated in practice, there are tools that we can use to get closer to that actual independence. And what we've done here is we've used principal component analysis to do that and determine some sort of linear combination of assets in our portfolio to accomplish this and develop a portfolio that is maybe closer to this idea of independent. Now, what are some of the implications of violations of independence in the sense that we don't use tools like PCA? Well, you could look at 2008 where everything in a portfolio is maybe assumed to be uncorrelated with one another, and risk metrics tell you one thing, when in reality, the likelihood and probability of loss and extreme loss in that case was severely underestimated. And that's the problem with this independence assumption. The independence assumption is that you're underestimating risk. Again, this is going to go in both directions relative to your period, relative to the correlation in that period. But nevertheless, it's going to over and underestimate risk. So in this assumptions violated setting, we really need to understand which facet or which assumption is responsible for this estimation error, right? Because if we have a regime where the tails are particularly fat and something happens, right, that's going to say one thing, and a period of high correlation and a period of these correlated assets moving together in one direction is going to say another thing, because that's a lack of independence versus tail risk. And that's exactly what we're seeing here relative to the first example with the excess kurtosis. Now, something to keep in mind in this setting here is this is in sample. If we were to do this out of sample, what would this look like? This brings us to number 3. This brings us to non-stationarity and time varying parameters. This will hopefully bring everything together that we've talked about up until this point. But the idea of non-stationarity is, in a parametric sense, all of these parameters are changing over time. Their stochastic processes themselves, they don't converge as time marches on. This makes sense if you just think about it logically and you think about a company in the early 2000s relative to now. It's not the same company. So would you assume that the returns would converge to a mean value given 25 years of changes at that company? Likely no. It's a completely different regime now, right? Macro regime administration and that company in general is completely different. So that's just one argument for why these parameters change over time. But what are the implications? Well, if we take a look, this is the exact same strategy that I just visualized here. I've taken the principal component 3 and I've constructed a linear combination of assets in my portfolio, and I am trading that as my portfolio, and this is the equity curve. Subsequently, if I did this out of sample for the following 5 years, so now I'm looking at 2022 to 2025, I'm using information from 2022 to construct the weights going forward. And here what we have is the S&P 500 clearly outperforms that PC3 portfolio. So even though in this instance, idiosyncratic exposure outperformed S&P 500 or market exposure, here it's not the case at all. Idiosyncratic exposure did not outperform. In fact, it likely changed because the levels, and that is not just the levels, but also the loadings on each of the factors are going to change over time for the principal component. So that is the idea also of non-stationarity, is that it's not going to converge as time marches on. So those loadings are also going to change, which is why this portfolio may not even be an accurate representation of the true PC3 portfolio. Just something to keep in mind in that time variant sense. Moreover, when we start to look at different mean levels of returns, you can see that based on how we compute the mean, we're going to get a different value. And there is no one correct value. You can't just look up, hey, what was the mean return of Apple stock this year, right? How do you compute that? Are you computing that on a rolling basis? Is it the cumulative average? Is it going to be, some sort of weighted measure? There's 10,000,001 different ways to compute that, and that's because it's a time varying parameter. So here you can see that the cumulative mean is going to kind of stabilize for this period around a negative value. But if the S&P 500 stabilized around a negative value, we would certainly be hurting more than we are in general. And that's just not the case, right? For this particular period, it ended up being more negative. And as time marches on, it's going to end up being closer to 0 and more positive. This is from 2021 to 2022. If you look at 2022 to 2025, this is absolutely not the case. Moreover, look at these measures. We look at the 10-day rolling mean. We look at the 30-day rolling mean. They track completely different levels. So this is the idea of the non-stationarity. And this is where, if you try to parameterize a distribution by some sort of historic mean or some sort of historic standard deviation, because remember, you need to use historic mean to compute the historic standard deviation, all of these are wrong in general, right? And then if you use a parametric model, you assume normality or something like that, you parameterize it based on this data, which is already wrong. Now you're double wrong. And then you start to look at things like, okay, we're assuming that it does follow this distribution. We're assuming that that mean is correct. We're also going to assume independence. What in the world is happening? All of these stack on top of each other to create more and more wrong inferences. So that's really the purpose of this video, is to show under the hood what is actually happening and what are the implications of these violations in practice. So in the context of using some sort of normal distribution, let's look at all of the layers as to why it's wrong. So we start with this idea of estimating a mean. We start with this idea of estimating mean return. In order to measure variance, standard deviation, any other statistical moment, we need the mean. And we know it's not a stationary process. We know that mean is not going to converge to a specific value. Maybe more measures are more correct than others. I probably don't want to use data from early 2000s to inform Apple's stock return for this year, right? But nevertheless, we have to discern some sort of mean level. Okay, so that first mean level is incorrect. Then we need to assume some sort of distribution if we're using some sort of parametric model. So we assume normality. And if we assume normality, we have to parameterize that distribution by a mean and variance. And that mean and variance is coming from this flawed historic data. Okay, but we also know that that normal distribution doesn't exhibit the kurtosis that we've seen empirically. So now you're double wrong. The mean is wrong and your tail risk estimation is also wrong. Okay, well, what happens when we analyze the parametric model for all of the stocks in our portfolio? We try to look at something like the value at risk. We're assuming that everything is IID and there's no correlation structure. You can always impose a correlation structure. You can always do things to correct these assumptions, but that's not the point. If we look at it just in the context of a basic normal distribution, we're assuming that the draws are IID. And that's also incorrect for a number of different reasons, because the parameters change over time. The draws themselves are not independent. There could be this idea of trend. If everything is bad and things keep getting worse, then there is going to be some covariance structure. All of these things make these models incorrect. So it's very important that you understand where the incorrect and the error contribute to the different levels and measurement errors in the quantities that you are trying to observe and measure. Because if you know that your parametric model is going to underestimate risk on both sides of the distribution, then your value at risk measures may be severely over and underestimating for a particular period. Same thing with the correlation structure. If there is no covariance structure, then you may be underestimating the risk, when in reality there is some sort of covariance structure and the risk measure should be higher. Same thing with this non-stationarity. If a mean level is lower than it is going to be, then you may be underestimating your risk, or overestimating your risk. Is going to be overestimating versus underestimating relative to what that true level is going to be for the following period. There really is no correct way to measure these values for your models. It's all going to be left to what you are trying to do, the assumptions you're willing to make, and how you want to handle how they're violated in practice and your interpretation of the violations in practice. So here what I've done is I've also visualized the value at risk. This is the one-day value at risk for a portfolio. But to measure the mean, what you'll see maybe in a very basic undergraduate finance class is, hey, let's just measure the daily return for the past year and use that. Okay, but is that really a reasonable measure for that level of that distribution? Well, here what we're doing is we're looking at a 30-day window, 60-day, 120 and 252-day window. We're looking at the 90, 95%, and 99% value at risk. And what we have here is a series of different measures. Which one is going to be the most correct? Well, that's entirely arbitrary to the period that you're analyzing, both in and out of sample. So this is going to come down to just the overall modeling process, where you're going to have to go through, you're going to have to collect some data, you're going to have to develop this idea of a model, You're going to have to fit this model to some sort of in-sample data. You're going to validate this model, and you're going to test this model on some sort of out-of-sample data. And then you're going to compare this to a different model. And that is just going to be the research process in general. Some closing thoughts relative to this idea of trading with violated model assumptions. Just because your assumptions are violated does not mean that you can't make money, but it is important to understand how this impacts your risk profile, how this impacts your profitability, how these regimes and structural shifts changing over time may impact the overall viability of your model. And this is why the trading landscape is really a full-time job. There is no set and forget trading system where you just turn it on and it prints money for you. There are different strategies that you run under different conditions and market climates and whatnot. And those strategies have different types of edges and whatnot. And when you deploy those strategies under certain regimes, it starts to turn into this art of, okay, we've seen this before, it's likely that this edge is still there, or we haven't really seen this type of strategy deployed in this environment before. Maybe we should hedge, maybe we shouldn't deploy this strategy in this environment. And it starts to become a bit of an art and discretionary rather than just simply input-output. When you're trading with, maybe something like implied volatility, what causes a spike in implied vol for you to want to collect some sort of risk premium you may be inclined to not trade that strategy, right? So if something like an idiosyncratic risk for that firm caused a spike in implied vol, maybe you're like, oh, we've seen this before, it's all good, it's going to normalize, we'll collect the spread. But what if it's some sort of macro factor, something like tariffs, which you don't see all the time? Is that vol going to normalize in time for you to collect some sort of spread or profit? That's exactly the work that goes into trading. That's exactly the art that it is.